The S&P 500 is down 16%, Nasdaq has dropped by 21%, and with the overall market sinking 300 points in a day, the famous Fear and Greed Index has plummeted to number 4, which is classified as extreme fear. The last few times the index was this low were during major market meltdowns like the 2008 financial crisis and the COVID crash of 2020. So it begs the question, is this another market crash? Is this panic? The truth is, nobody knows how deep this will go, and that's the reality of investing. There's always uncertainty, and nobody knows the future. What's important to remember is that the stock market is always cyclical, driven by unpredictable human behavior that feeds into the market movement. Right now, fear is the dominant force. And historically, when fear dominates the market, it often creates undervalued opportunities. In this video, I'm going to explain how not to let the irrationality of the market affect you, how to identify stocks that can give you confidence, and how deep we should go when buying the dip. While long-term returns are usually pretty steady, the short-term can be a wild ride. It is because volatility often causes people to react emotionally, panicking and selling at exactly the wrong time. But in the same time, calm and disciplined investors are the ones looking for bargains. Fear pushes money into safe zones like gold, U.S. Treasury bonds, and defensive sectors like utilities. But declining stock prices actually make investing in stocks less risky, because lower prices increase the margin of safety, MOS, for new investments. If the company is a wonderful, profitable business with growing earnings while its market price drops, in fact, prices often fall well below what companies are truly worth, bringing them back down to earth, or even lower. That's why emotional sell-offs can create great long-term buying opportunities. History tells a very clear story. The market always crashes by double digits, but it always recovers. During the dot-com bubble of 2000, the market fell 49%, and Amazon dropped 95% before soaring 3,600%. We can also mention the big financial crisis of 2008, when the market plunged 57%, and Apple, after its fall, went on to surge 1,200%. Or just 5 years ago during the COVID crash of 2020, when Visa slid 38% and then climbed 96%. Now, who knows? Maybe the current Trump tariff standoff will trigger the next crisis and produce its own set of winners. The pattern remains the same. Selling in panic might seem like the safe choice, but it's actually one of the most expensive mistakes you can make as an investor. This is something many people forget. Market downturns are a normal part of the investing journey. They're not something to fear, but something to understand and prepare for. If you can stay calm while others are panicking, you give yourself a real advantage. It's one of the few true edges you have as an individual investor. As history shows, the market tends to reward those who stay patient and maintain a long-term mindset. However, that mindset must be coupled with value-focused investing. As Warren Buffett said, we need to find wonderful companies at a fair price. But what does that actually mean in practice? It means avoiding deteriorating businesses that merely look cheap, hoping they'll somehow bounce back. Instead, the focus should be on companies that consistently grow in value over time. Businesses that, through their operations, will be worth more tomorrow than they are today. The goal is to understand the real or the intrinsic value of a great business and buy it when it's trading below or at that value. We want to buy high-quality businesses for 50 cents that worth $1 or more and share the following qualities. A company with a wide moat. Moat is a metaphor that Warren Buffett used that compares a business to a medieval castle, where the castle represents the company and the moat is its protective barrier against outside threats, the competition. A castle needs a wide, deep moat filled with water to keep enemies out, to protect its profits from rivals. Similarly, a company with a strong moat has a strong competitive advantage. A company with growing revenue and earnings. If a company can steadily grow its revenue and earnings over the long term while maintaining its profit margin, then the company is in a wonderful position. We're looking for compounding growth rate from 10 to 20% for 3, 5, 7, and 10 years. Also, the growth has to be consistent because it plays into the performance of the stock. Moreover, consistent earnings expansion usually helps the company to reinvest in high-return projects, pay dividends, or reduce debt, increasing the value of the stock. High profitability with low capital needs. We are looking for asset-light businesses with a high return on invested capital. When a company operates a capital-intensive, not asset-light business, a large percentage of its earnings is typically reinvested into the business to buy and maintain equipment and increase inventories. This is necessary to stay competitive and grow, However, it is even better when a business not only requires few assets, but is also protected from competition with few capital. These businesses tend to have high return on invested capital and carry little debt. We're aiming for return on invested capital, or ROIC, of 15% to over 20%. When we talk about a healthy balance sheet, we're looking for strong liquidity, meaning the company has enough cash to easily cover their debt. They shouldn't rely on borrowed money, so they're less likely to run into trouble if interest rates go up or the market takes a hit. And if they do have debt, they need enough cash to manage it in a way that's easy for anyone to understand. The business should have high-quality assets that truly hold their value over time, like cash, receivables from reliable customers, or valuable properties that are not inflated or questionable holdings. To determine the health of a balance sheet, one key tool we use is the debt-to-equity ratio. This measures how much debt a company uses to finance its operations compared to its equity or capital. Ideally, we want a debt-to-equity ratio of less than 1. That means the company is financing its operations more with equity than debt, reflecting lower leverage and lower risk. We also prefer asset-light businesses. A helpful indicator here is the CapEx to operating cash flow ratio. This tells us how much of the cash generated by the business is reinvested back into the company for growth or maintenance. If this ratio is less than 1, it means the company generates enough cash to comfortably fund its capital investments. When we talk about plenty of growth opportunities, it's important to remember what Warren Buffett said. All earnings are not created equal. If a business is asset-heavy and wants to double its revenue, it has to double the amount of capital tied up in inventories, equipment, and other tangible assets. And even then, a business needs to generate at least as much market value as the capital it reinvests. And that's a hard thing to do. But companies with strong growth potential, especially those running asset-light models like tech firms, software companies, or certain service industries, hold a major advantage. The aim is to find companies that need very little additional capital to grow, letting them scale faster, operate more efficiently, and deliver greater value to their shareholders over time. Trustworthy management with skin in the game is a requirement, so you have to ask these questions about the leadership. Is the founder still leading as CEO? Does the CEO have a solid track record and years of experience? You want to feel confident that the people in charge treat the business like it's their family's only source of income, and that they're not just chasing short-term gains at your expense. Finally, you have to understand the business you're investing in. You don't need to be an expert in everything. Warren Buffett has most of his portfolio in Apple stock, but I'm sure he doesn't know how the iPhone's operating system is coded. What matters is understanding how the business makes money, who its customers are, what drives demand, and what risks it faces. This isn't about perfectly predicting the future. It's about building conviction through reasoning. And now, let's wrap up this video with the much-awaited topic: how far should we go when buying the dip? To answer that, we need to determine the margin of safety, or MOS. And for that, you need two key inputs: intrinsic value, what you believe the stock is truly worth, and market price, the current trading price of the stock. Depending on your analysis, the intrinsic value may be overpriced or underpriced. There are several methods to calculate intrinsic value and the margin of safety: discounted cash flow, DCF, earnings-based models, book value especially for asset-heavy businesses, and the dividend discount model, DDM, often used for dividend-paying stocks. To learn which method fits which kind of stock, and to go deeper into each of these valuation strategies, make sure to subscribe to the channel and hit the like button. For high-quality companies, we generally aim for a 20 to 30% margin of safety below the market price. But always remember, intrinsic value is an estimate, not a fact, so leave room for error in your judgment or analysis. Thanks for watching, and I'll see you in the next one.